Joining us now is Eric Sheridan, Goldman Sachs co-leader of the Technology, Media, and Telecom Group. Eric, arguably great news this week on ads from Meta and even Reddit. Great news on cloud and AI demand from Microsoft, too. So, I mean, we're kind of ending on a downer, but is the message overall encouraging or no?
The message is overall encouraging. The digital economy is accelerating against a lot of fears about what the economy looks like in the back part of the year. The spend levels around AI continue to build in momentum. The deployment of AI into both the enterprise and consumer computing landscape are accelerating in momentum. But we are in a period where taking pauses and digesting moves and digesting risk factors in the market can lead to days like we're seeing today.
Explain to me the Amazon disconnect. I mean, it's okay for Meta and Microsoft to spend all this money on AI, but we're concerned about an Amazon earnings guidance miss. Is it because the nature of it is different? Is it because the AWS growth rate isn't what some might have hoped?
Well, it's a great question, John, and I think I would make three quick points. One, there was a slight disappointment on AWS revenue relative to the type of reacceleration we saw at Google Cloud and Microsoft Azure. Second, the company didn't exactly hit the mark on their earnings call last night, and you didn't hear the sort of explicit language that some investors wanted to hear about how supply coming unlocked in AI can unlock revenue reacceleration in the back part of the year. We believe that revenue reacceleration is coming, and we believe our industry work would point to that supply coming online already, and therefore our confidence interval is up, but investors didn't hear it as much as they wanted to on the earnings call last night. And third, there are reported growth rates that we think need more examination between the types of growth rates you're getting from Microsoft and Google Cloud relative to AWS. And if you layer in analyses of different revenue exposures, we think it's a more easy story to explain, but it is complicated.
Okay, so we had big tech broadly lower today. What would you buy here?
Amazon, we think, is a very disproportionate risk reward from current levels. Not to pivot away from the AWS narrative, but their commerce business accelerated, the margin improved, the advertising business accelerated. We believe increasingly you're looking at $8 plus of GAAP earnings for Amazon in 26, $10 plus in 27. That's increasingly becoming a cheap compounding growth story against these fears. We'd be buyers of Amazon probably as a leader of the pack in our coverage coming out of this week.
Okay. So is mega cap tech still defensive, especially if this pullback that we saw today develops into something deeper?
Well, I think defensive might be too far a word. I think GARPy, or growth at a reasonable price, is where these names are starting to find a real home. I mean, you are paying earnings multiples against top-line growth and earnings growth that we think are looking increasingly compelling on a multi-year view. And while you might still be tethered to elements of the AI narrative leading to volatility on a month-to-month basis, increasingly the strength in the digital economy relative to the overall economy, strength in the AI economy relative to consumer and enterprise landscapes will win out the day over longer duration narratives, but you can get fits and starts from a volatile nature in individual weeks or months.